All right, I want to thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors with the Retirement Group. We are a registered independent advisory firm, and we've been working for 20 plus years helping corporate employees transition into retirement. Our key goal is helping you understand your benefits plans and all your retirement options as you transition, so that hopefully, whenever you do transition, we're helping you leave with the greatest amount of benefits you can leave with. From that point, we hope that you throw our hat in the ring when it comes time to helping you manage your retirement assets as well. As what we'll go through today is talking about different strategies we utilize to help our clients minimize their taxes so they keep more money in their pocket. We're going to center this around a lot of Roth conversations. This is a piece of our tax planning seminar that we do all across the country. This is just one little piece of it. So we're going to spend a little bit of time just going through that. And if you have additional questions about some of the other items we cover, like in UA, just let us know. You can reach us at 800-900-5867. So just want to kind of go ahead and take a look at some of the different options that you're going to be looking at whenever you do transition. For most of the companies that we work with, they tend to have both a 401k and a pension plan. So you have a couple of different options there. With your pension plan, we go through a whole nother webinar as well as seminar on the different options between lump sum or single life annuities, joint annuities, period certain, all the different choices you have there. We also run a cash flow analysis that will help you determine the best choice for you, so you can look at some of those options side by side. So definitely give us a call to go over that as well. But generally speaking, if you have your savings plan or your 401k, you've got a couple options. You can keep that within the 401k plan, or you can roll it over to an IRA, in which case you can manage on your own, or enlist a company like the Retirement Group to help you manage those assets. That transition, if you roll over your 401k as well as a potential pension lump sum, there's no taxes associated with that until you withdraw it. It's just a transfer from one account to the other. So that's one thing just to keep in mind. Again, as you transition, there's no taxes associated with it. But what we have a tendency to do is help you determine some different ways to make that transition even more tax favorable to you, in which case you can actually eliminate taxes, depending upon if you have some after-tax portions or Roth portions in there. And that's what we're going to discuss a little bit more today. So generally speaking, with most 401ks, you have an option to make contributions pre-tax or after-tax. In some cases, you have a Roth 401k option as well. Just the basic difference of those is a pre-tax contribution. Let's just say you make a $10,000 contribution. Now, obviously, when you make your contributions, it's a payroll deduction, so it's a percentage that's coming out each pay period. But let's just say you put $10,000 in for a year. If you did that on a pre-tax basis, that means that's coming off your taxes for that year. So let's say you made $100,000 for the year, but you made a contribution of $10,000 in your 401k. When you file your taxes, it looks like you only made $90,000, so you're actually saving taxes on that $10,000 right now. Now, as that sits in the 401k and grows, eventually when you decide to take that out, you are going to pay taxes on that entire amount. So that $10,000 could double or triple, but eventually you'll be paying taxes on that money. The other option is if you put that money in after tax. In that same example, if you made $100,000 but put $10,000 in after tax, you're still getting taxed on the entire $100,000. The difference is that $10,000 you put in there, it's already been taxed. So when you do retire and you do decide to take that out, you don't have to pay taxes on that $10,000. Now, the growth or the earnings within the 401k, unfortunately, you are going to have to pay taxes associated with that. Another benefit would have been if you were able to put that into a Roth 401k, because the earnings there are going to actually grow tax-free. Now, a lot of the companies we work with, they've been putting in after-tax money in the past because there's less restrictions on accessing that money while you're still working. So for some people, it's a good rainy day fund. But what we recommend is if you retire and you have after-tax money, or even if you're still working and you have after-tax money, we need to look at a review of Roth conversion options or Roth rollover options. Because what's going to happen is if you can take that money, let's give a quick example. Let's say you've got a 401k with $300,000, and let's say 10% of it, $30,000 or so, is going to be after-tax money you put in over the years. So what happens is if you're just to simply roll that $300,000 over to an IRA, the cost basis of that after tax at 30,000s Still going to be tax-free, but all the growth is going to be taxable. Whereas if you split that up, you can do what's called a spillover contribution. Take that after tax, that 30,000, roll that over to a Roth IRA, and roll the larger portion, the 370 that's left, over to a traditional or a rollover IRA. So that 370 is going to continue to grow tax deferred just like it would in the 401k. But again, in the IRA, you've got a lot more investment choices, and you can also use a company like the retirement group to help you manage it if you need that help. But that $30,000 will go into a Roth IRA, and that cost basis is there. So if you need to access it, you can access it without any taxes. But the real benefit is the growth of it. Assuming you leave that in there for at least 5 years, as well as after you've reached 59 and a half, you're actually going to pay no taxes whatsoever on the growth of that $30,000. So let's say you keep that in there for 10 years and it doubles to 60 grand, then that entire 60 grand is going to be tax free. Whereas if you had kept it in the 401k or rolled it over to an IRA, that growth, that extra 30 grand, would have been taxable. So it could have cost you another, $5,000 to $10,000 in taxes maybe. So right there alone, we're looking at trying to help you save some tax options within there. Whenever you look at the taxes associated with 401ks, there's a lot of different situations, but generally speaking, that pre-tax money when it comes out is going to be taxable at whatever your tax bracket is in that given year. Right now, we're in some pretty low tax brackets. So that's one of the benefits of looking at some of these rollovers and especially Roth conversions at this point in time, because we know what your taxes are, but we don't know what they're going to be in the next 5, 10, 15 years. It's safe to assume they might be higher, just given the state of affairs. But whenever you do take a distribution, if you take it before 59 and a half, there could also be a 10% penalty associated with it. But there are a lot of different exceptions, like running a 72T, taking it from your 401k, you turn 55 or later, disability, health options, adoption, things like that. But generally speaking, it's going to be a 10% penalty under the age 59 and a half. Now, taking it from a 401k would also be a 20% withholding. That's just withholding. It goes towards your taxes. Doesn't mean that's what your taxes are. You're not going to know what you're paying until you actually file your taxes and find out what your tax bracket is. And we'll go over some of those different options. And one of the things that we do year in and year out with our clients to help them minimize and control their tax brackets. Whenever you do transition and you are fully retired, it used to be at age 70 and a half, you had a required minimum distribution where the IRS came knocking on the door, told you, hey, whether you need the money or not, we're going to force you to start taking some of that money out so we can start taxing you on it. The Secure Act came through this year in 2020. One of the beneficial changes, there are some good, some bad to it, but one of the beneficial changes is they moved the RMD age out to 72 if you hadn't turned 70 and a half by 2019. So you got an extra year and a half or so you can defer those there. So really between age 59 and a half, that's a year where you have no 10% penalty, and 72 is where you have to start taking it out. There's a lot of flexibility within those years. So we work with our clients, and usually come November timeframe or so is when we look at reviewing their tax situation for the year. We wait till November because that way they've had most of the year. There aren't many surprises left as to possible distributions. We have a better idea of what their income has been, and we'll help them determine whether or not they should look at a Roth conversion for this year as well as subsequent years, and help them determine how to reduce those taxes in the long term. So let's take an example of somebody who retires at 60 years old and they've got $1 million in their 401k or an IRA. If they just left that and were taking money out of it for what they needed each year, eventually once they turn 72, depending upon how much they need, they're going to still be forced to take required distributions. And at that point in time, in 12 years, I don't know where tax brackets will be, but chances are they'll be higher. So if you kept all your money in a 401k or kept all your money in an IRA, you don't have that much flexibility when it comes time to paying taxes. It's going to be pretty much all taxable. So if we can work with you year by year, let's say you're able to move over 10, 20, 30, maybe 50,000. You can move the entire million in 1 year if you want to, but it's a pretty big tax bill to buy it, so it's kind of hard to do for most people. But let's say you can move over $50,000 a year for the next 12 years. That's moving $600,000 out of your IRA, moving it to a Roth IRA. So all that money is growing tax-free for yourself as well as for your beneficiaries if you don't need those funds. As long as you keep it in there for 5 years, all those earnings will be tax-free. So that's one great way to minimize your taxes personally. And then again, if you're looking to pass assets on to your beneficiaries and minimize their taxes as well. One of the other new changes with the Secure Act here in 2020 was the removal of stretch IRAs for non-spouse beneficiaries. Now they're required to take those out within 10 years. Unfortunately, I had a client who just passed away in January, and the assets went to both of his children. So as opposed to them getting to stretch that out over their lifetime, they have to take all the money out within 10 years. So in that case, if more of it was a Roth IRA, there's going to be less taxes associated with that. So again, that's one of the great benefits to look at it. So I'm not going to spend a lot of time here, but this gives you a snapshot of the tax brackets here for 2020. If you take a look at, let's do a quick example. Let's look at the married filing joint. Let's take a look at that 12% tax bracket. If you scroll over there, the top of that's just over $80,000. Now, on top of that, the standard deductions is going to be a little bit over $24,000 right now. So you're just shy, right around $105,000 of income. You're only in the 12% tax bracket. Now, the jump from that to the next one is 22%. So that's the biggest jump. That's a 10% jump. So let's say in that example that we talked about, the $50,000 being rolled over or converted to a Roth IRA each year. Let's say that it's a married couple that they live within their means, and all they need is let's say $60,000 a year for income. That's all they're actually spending. So in that case, if they're at 60,000, we know they can go as high as 105. That means there's $45,000 that I would argue they should look at a Roth conversion, pay the 12% in taxes just because 12% is probably the lowest we'll ever see, and get that moved over to that Roth IRA so that can continue to grow tax-free, not just tax-deferred. Otherwise, they can continue to let that stay in the 401k, but eventually, the 401k or the IRA, but eventually, even if they only need that 60 grand, inflation sets in, they'll probably have to take more in the future. And the tax brackets may change. That 60 grand may jump up to 20, 22, 25% tax bracket somewhere in the future. So it's definitely a case-by-case situation, but we just need you to know that we do this year by year with all of our clients, and this is one great way beyond the management of the assets, but managing the taxes to make sure they keep you keep more money in your pocket. So one of these things you can do actually while you're still working is with that 401k Roth conversion strategy. If you haven't done anything, don't fret. You can actually start making contributions on an after-tax basis. But give us a call. We'll talk with you about the benefits of pre-tax versus after-tax or a combination. And depending upon your plan, some plans have different provisions. But if you put that money in after-tax, you could potentially each year just convert that over to a Roth IRA. So you can effectively bypass the Roth cap limits, which is currently about $7,000. And you can put in up to close to $35,000 into your 401k on an after-tax basis, and then just turn around and convert that to a Roth IRA. But again, that's company specific, depending upon the rules of rollover options they give you. So just give us a call, 800-900-5867. We'll be happy to walk you through that and let you know what your plan options are. So with that, we'll kind of wrap this up. Again, that was just a brief portion of the Roth options within 401ks and IRAs and rollovers. But whenever you do transition, just make sure that you do understand the risk and returns associated with your investment strategy. Make sure you minimize mistakes and follow the concepts. We didn't go through them here, but the concepts that we focus on as far as for a sound transition to retirement. Make sure you interview companies like the Retirement Group. Look at more than one or two, but ultimately figure out which one you feel most comfortable with. And make sure that you monitor your portfolio on an ongoing basis. We can help you through that as well. And make sure that you look at a detailed cash flow analysis. That's one of the things we provide as well to help you determine that best day to retire, as well as let you know what your retirement picture is going to look like as you move through retirement over the next 20, 30 years or so. So if you are working with another advisor, that's great. We would recommend you get a second opinion. We recommend our clients do this every 2 or 3 years, actually, just to keep us on our toes, make sure we're doing what we're supposed to be doing. And I would offer the same to you. So do make sure if you're working with somebody that even if you're happy with them, make sure they understand your benefits inside and out, especially if you have not retired yet. So that way you can work with somebody that can help you maximize the benefits whenever you do transition. Understand their fees. Everybody gets paid a fee. We are fiduciaries. We are transparent on our fee structure. We're not a one-size-fits-all firm. So our fees tend to be some of the lower in the industry, so feel free to review that with us after we go through cash flow analysis with you. Make sure to work with the investment management team. I'm not doing all the investment decisions here. We've got a team that backs us in the home office, as well as coupled with our research through Schwab, who's the custodian of most of the assets as far as our clients. And just find out what it is you value, but to also make sure you do run that cash flow analysis and make sure it's a detailed, conservative cash flow analysis. Don't be optimistic about the markets or your spending. We want to be pretty pessimistic. So if you survive one of our cash flow analysis, you're going to be in pretty good shape probably throughout retirement. And with that, again, I'm just going to wrap it up. Any questions, feel free to give us a call. You can reach me directly. Again, that's Wesley Boudreau at 281-624-5020. The main number for the retirement group is 800-900-5867. And feel free to look us up on the web and our blog, and join us for other webinars we have in the coming weeks. Thank you very much, and I hope everybody has a great day.